Well, it's Friday night, the very first Friday of the month, which is when Cathie Wood always provides us with her insights into the overall market, the macro, and also usually gives some insights as to how that might be affecting some of the stocks that she follows, including Tesla. That's why I pay so much attention to what Cathie has to say once each month. And you can listen to the whole thing. I highly encourage you to do that. But if you'd rather get the hour's worth of content into about 15 minutes, that's what I try to do each month. Plus, I get my own variation, my own version. Do I think that I know as much as Cathie Wood? Heck no. But that doesn't mean that sometimes even bright folks like Cathie can be wrong. She might have been wrong to sell Nvidia in January and February. She says, no, I already made jillions of dollars on Nvidia, so moving my position made sense. And of course, she doesn't have a crystal ball any more than the rest of us do in terms of Nvidia going nuts after their call. All right, so let's, this is Randy Kirk. Hit like if you like me doing this thing on Cathie Wood every month. If you don't hit like. Seriously, let me know one way or the other if you think this is valuable to you. And if you want to wait until later to make that decision, great. But it really helps me. If it's not valuable, I won't do it anymore. But if it is, I want to continue to do it. Obviously, all of this takes a lot of time and energy. And I thank the Patreon members who help out by supporting the channel. You guys are producers. The channel is successful partially because of you, and I thank you. And for the rest of you, if you'd like to help the channel, look down below to see the information on how you can also spend a whole $5 a month and help this channel become more successful. Okay, so let's go down and see what Cathie had to say. By the way, at the end, I'm going to do a little special thing. She did it at the beginning, and if you want to see this special thing, great, take a look at her whole video. But she did a special thing talking about the effective what's going to happen next with regard to AI. And I thought that was pretty interesting, and you might as well. So, all right, let's start off. Cathie expects a hard landing. Now, she's talked about that all the time. She kept saying over and over again that she thinks the economy is going to have a harder landing than everybody else thinks it's going to have. And yet, when she was done with the entire video, my sense was she doesn't really expect that hard of a landing. So you could listen again and get your own impression, but all in all, it sounded to me like she might think a hard landing would be that we get to zero increase in GDP for a couple of quarters in a row, thinking the third quarter might be the worst, and that we might be back on our way to something good by the first quarter. That would also be closely aligned with the idea that this rally that just started might be the real thing. It might actually be the beginning of a bull market. Now, Cathie went on to say, no, we've actually been in a bull market since the beginning of the year. That would be unusual if the market was really going to go, if the overall GDP was going to go south in the third and fourth quarter. So you figure that out as best you can. My analysis is no, we are not going to have a recession in the third and fourth quarter. We are not going to have a recession, period. We're going to continue to see growth. We'll talk about the employment numbers later, but I think the employment numbers tell us there's not a chance in the world that we're going into a recession anytime soon. And that, yes, it's possible that the bull market started in January, even though it's been fairly narrow in the techs. We'll talk about that a little bit later too. It's been a narrow rally up until now, but we've seen some broadening out just this week, which may be late. In other words, we've had a late broadening out compared to what it might have been if it hadn't been for this whole debt ceiling deal holding the market down. Anyway, a lot of good news in this report. She believes that the inflation will drop faster than expected. I'm going to do a special analysis. I might even do that for Sunday morning. Maybe it won't be till Monday afternoon. I'm going to take you through the entire Truflation analysis, how they get to what they get to, where they are now, in depth, in detail. I think that this is going to be a very important thing for you to see. So hit notifications if you want to be reminded about this Truflation video that I think I'm going to do. But I'm pretty sure I'm going to do. It's just a matter of which day do I report it. All right. So she thinks inflation will drop faster than expected. Truflation is showing that right now. They're showing it already under 3%. And then that would be followed by interest rate drops. So the Fed is saying, nope, we won't drop any interest rates this year. But believe me, if they start to see inflation going towards zero, they will. And Cathie is suggesting that could happen faster than we think. There's plenty of evidence that inflation has cooled dramatically, in particular in commodities. But again, we'll talk about that when we talk about commodities. But we could be looking at going below 2%. And if that happens, obviously the Fed is going to start reducing interest rates. Okay, bonds are also evidence of what I just said. So we'll talk about bonds in a few minutes, but bonds are staying very steady. The 10-year bond is staying very steady in that 3.5% range, which indicates that they don't believe, the bond market doesn't believe that inflation is going to continue as a problem, but in fact that it's already possibly down as low as 1.5%, or at least that the overall impression going forward is that inflation is going to be in the 1.5% range, not above 2%. We have the fear of default was much higher. The fear of the government defaulting was much higher than I anticipated that it was. I was reporting that I thought it was a nothing burger that was never going to happen. We'll talk about evidence that the fear of the default was huge. And of course, one of the evidences would be when the bill was finally passed, we saw a broad market recovery. The M2 continues to drop. It has dropped 4%. 4%. Hello. It has dropped 4%. I can't say it. 4.6% year over year in April. Cathie expects it to drop 5% or more in May. When you have a dropping M2, when your money supply is dropping, then something has to give. Either you do have to go into a recession, or you have to have an acceleration in the how many times you're turning the money supply. It's unlikely that that's going to increase much because it's already pretty high. So that's one of the evidences Cathie is giving that we are going to have a zero or negative economy in the third and fourth, both the third and fourth quarter. She thinks the fourth will be the worst. Okay, so let's see what else here. We got she continues to believe there will be a pause. She thinks that that's not necessarily based on obvious data that came out of today's employment numbers, but let's take a deeper dive. I did some stuff on the employment numbers earlier today, or was that yesterday? I can't remember now. Let's see. That would be Friday night. This is Friday. Yes, Friday night. That's why I'm confused. You'll be seeing this Saturday morning. On Friday night, I did an analysis of the employment data. After that, I did a little deeper dive, and I came to almost exactly the same conclusions as Cathie, but not quite. So first of all, what I didn't report on was that household employment was down 300,000. That is a leading indicator. But the divergence, when Cathie talked about the divergence briefly, but the divergence of seeing 339,000 new jobs in the marketplace, but as reported by looking at the survey of these employers that they do each month, but showing a household survey with 300,000 less people in households working, that speaks to me of bad data. Okay. And when you look at last month's data from the labor statistics, where they made a correction of 80,000 jobs, I'm saying the data is not looking very clean right now. And I'm thinking that's what's causing this divergence. However, Cathie thinks the divergence is caused by a fact that a leading indicator is when the household survey goes negative, even when the labor numbers are high are up. So, okay, I'm okay with either one of those solutions. I think it's a data problem. I watched a video with Kevin. Kevin believes that it's a data problem. So one of those two things is going on. Cathie also mentioned it might be that people have more multiple jobs than they already had. I think that has a low likelihood because I think there was a lot of multiple jobs already. Small businesses laying off, they lay off earlier, and that shows up in that data. That's a possibility, but I haven't seen a lot of evidence of it in the real world. Haven't heard a lot of evidence from my associates that would be hearing that canary in the coal mine, but it's possible. All in all, Cathie's saying she thinks that that is a evidence that we're going to go into this harder landing, maybe going negative in the third and fourth quarter. I continue to say there's not a chance in the world when you've got 10 point something million job openings and only 1 million people looking for work. I just don't see it. Yeah, so but we did see more people coming into the job market. That was the JOLT report, and the JOLT report that would indicate just exactly the opposite, with people coming into the employment market. That would be either evidence that people are just ready to go back to work, but more likely, I stated in my comments on Friday night, you would have seen on Friday night, that this would be because of some of the changes in the law that are making it more difficult for people to stay home, and also the fact that people have exhausted their savings, and the amount of credit outstanding on credit cards is the highest that it's ever been. So that would tend to possibly cause some of this doubling up of jobs Cathie's talking about, but also cause people to get off the couch and go back to work. All right, the CPI. So the CPI was 3% in July. I'm sorry. Oh, she's saying she's expecting the CPI in July, reporting June, not the one that's coming up in 2 weeks, but the one that will come up in 6 weeks. She expects that to show the very first drop off, substantial drop off. Why? Because last June's numbers were at 12% year over year, and that's going to go away. So when you've got a month like that going away, then the average is going to be affected over that 12-month period. So when that happens, she's thinking it might show a 3% in July. That would be the Fed would at that point certainly pause and or start thinking about whether they need to reduce. The trueflation is also showing, as I mentioned, under 3% at this point and going down. So both of those things would potentially speak to exactly what Cathie is saying. She also expects CPI to go negative later this year, that soon. And why does she think that? Well, she thinks that because of the commodities going down and manufacturing PPI going down as well. PPI is already almost to zero, and she thinks it will also go negative shortly. So in the labor analysis, we also saw the work week shrinking, not by much, but overall the work week has been flat to slightly down since January. So that also speaks to the idea that the overall shortage in the economy of employees, and not having enough employees to fill all the jobs that are being advertised, may not be as strong as it looks like in this 10-to-1 ratio, because typically that's going to cause overtime. That's going to cause a longer work week, and we're not seeing that longer work week take place. So interesting, not 100% sure what all that might mean. Lots of, what do you want to call it? Fighting stuff, indicators that are fighting one another. So, all right, indicators all over the place. So consumer sentiment was down big. Consumer sentiment, Cathie's thinking it was down big because of inflation, because of the regional banks having trouble, because people are not getting as great a pay increase as the inflation was increasing, because they were worried about a recession, because that's all that's been talked about. They're worried about the government defaulting. All these things would cause people to have consumer sentiment issues, but it was down pretty big. And again, that would tend to indicate a potential coming recession. Oh, also, of course, if people have exhausted their savings and have increased their overall consumer debt, and they know that they're going to have to start making payments on their college loans, their university, their college loans, and they are seeing their interest rates go up on the loans they do have. I mean, all those kinds of things are going to start to cause people to potentially have sentiment issues. The manufacturing index dropped to a recession level of 42. Typically, what you want to see manufacturing, so 50 is kind of the average. When it gets about 50, you're like, okay, but at 42, she's saying that's recession level. So this would, again, be manufacturers' concerns are what they think is going to happen in the future. So that was low. By the way, though, housing expectations went up. So builders were feeling good. So you got all these conflicting indexes. Costco and Home Depot have both announced that they're going to be dropping prices. Now, that's kind of a shocker. Costco usually has a pretty clear indicator that they stick around this 15% margin. But they also said they're not going to raise their annual fee, which was on the table. So that's a couple of indicators that both of these companies are thinking we may need to yield to this consumer sentiment problem if we're going to keep our numbers up. The PPI was, as I mentioned, was lower than expected with a 2.3 year over year, and she thinks it'll be going negative. And so 2.3 year over year, that's well below the 3%. That is being shown on the Trueflation, and well under the 6%, 5%, whatever that we're seeing on CPI. The commodities were down by 29% year over year, and it's across the board except for silver and gold. So again, you can't have the commodities drop that much without some of that beginning to reverberate into manufactured costs of goods, which then can be passed on to wholesalers, et cetera, so it ends up in retail sometime later. Market indicators. Well, again, the techs were 75% of the increase in the market so far this year, the increase in equity values this year, 75% by tech. So watch for broadening. This would be something for you to take a look at. If you start to see this broaden out, that would be an indicator that this is actually a bull market. If it doesn't broaden out, then we could see a point where the techs have outrun. So we know the NASDAQ has been outrunning the Dow all year long. Commonly, NASDAQ up, Dow down. You see it all the time. If that doesn't broaden out, at some point, NASDAQ will be out way over its skis, and there will be a big pullback. Yes, I'm still in Kauai, where the chickens rule the island. They are in charge. You cannot kill them. You cannot eat them. You wouldn't want to anyway, apparently, but they are everywhere. And that rooster has decided to call our location home. All right, moving right along. Bond yields have remained in this range, right around 3.3 to 3.7 on the 10-year. Right now, they're at the high end of the range. But here's something Cathie said that I had no thought of. Really interesting. Hope you find it interesting. Also, this might be due to the fact that the Fed was not offering as many bonds to be purchased. Treasury was not able to continue to sell bonds in order to raise money because the debt ceiling was already being reached. So it may be that the Treasury will start providing more of this bond activity starting next week. And if you see bonds drop precipitously, that could certainly be the reason. Now, on the other side of the coin, the yield inversion, which had dropped and was starting to look like maybe it was going to go back to something closer to normal, at least on the 2-year compared to the 10-year. The 2-month is still way out there, but the 2-year compared to the 10-year was getting closer and closer. But now it's popped up back in the other direction. Again, this could be largely due to Treasury and how many bonds they're making available. I continue to say that the 10-year was also a flight to safety and a real investment opportunity for people who expect inflation to go down and therefore interest rates to go down and therefore eventually the bonds to go up in terms of the underlying value of the bond. Credit default swaps are flat. So that has become less of a concern. That means that if the credit defaults are flat, they haven't gone down yet, but they're flat. That would be an indication that the folks who write these insurance policies for corporate borrowing at banks and whatnot, they're seeing less of a concern from corporate borrowers and business borrowers. So that would be good news. Oil demand, she thinks the fact that oil has remained in the 70s, low 70s, and even dropped into the 60s might be an indication that the folks that trade oil commodities are beginning to believe in the potential for destruction based on BEV sales. You know, you're getting a lot more BEVs on the streets every single year. Those are not using oil and not using gasoline. And so that could be that people are starting to price that in, that we're going to see way less oil being used in future years. And people might be saying, I need to get out of this commodity. The dollar is up. That's another inflationary benefit. The inflation will be down when the dollar causes, by virtue of the fact that the dollar is traded versus other currencies. In other words, you have to see the dollar in terms of its value against the yen or the value against the pound or the euro. Then when the dollar goes up, that is deflationary for the US economy. The stock market has been up in the face of a possible hard landing, or let's call it a moderate landing. That is potentially as a result of automation. Maybe, again, folks are saying all this tech activity, all this chat GPT, all of this Nvidia, all of the BEVs, or potential automation of BEVs, all the things that are happening in terms of automation, these are all going to drive up the, it's going to create more efficiencies in the market. Okay, you get way more efficient when these things happen. Again, I'm so reminded of what happened when email took effect, when an owner of a company, even a small company like my company's, you would have dictated a letter to a secretary, to a stenographer or a secretary. Then that person would have gone in and typed a letter. The letter would have had to been perfect, and they might have brought that letter back 2 or 3 times and retyped it. You went all the way from that in a very short period of time to where CEOs were typing their own emails that would have earlier been gone through that entire process. That eliminated that category of secretary completely, and stenographer. That just completely went away, as well as made the owners, the CEOs, much more efficient at their correspondence. That was a dramatic change in the economy, and it was reflected in terms of efficiencies overall. Chat GPT and all of the other GPT related issues are going to have a similar effect, and I think it might happen a lot faster because corporations are going to be looking, and this is what Cathie said, corporations are going to be looking for the actual solutions, the software, the plugins, the apps that are going to be coming out of this GPT revolution that are going to be usable to reduce their labor, whether that's whether that's improving the efficiency of their existing labor, or whether that's actually taking labor out completely and replacing it with more automation. So she believes that's going to have a massive effect, that the AI training costs are going down by 70% per year. That's double Moore's law. And that has got to be being passed through to everybody that's in the space, to where it's going to be so inexpensive to create apps, to create websites, to create all these things, to create content like I'm creating right now. It's going to be so much faster and easier, and this is going to ripple through the economy very rapidly in Cathie Wood's thinking. And that means who's going to be the big beneficiaries? The big beneficiaries are going to be the people who have the data, and the people that can take advantage of these new apps, and the people who create the apps. So those are the companies to be looking for right now. And what company comes to mind that has lots of applications for AI that they are using to make less expensive products or services? Oh, let's see. There could be a company called Tesla that's using AI in their insurance program, that's using AI in their energy storage program, that's using AI in their factories, that's using AI in the rest of the overhead of their factories in terms of bookkeeping, et cetera. Will probably be using AI in the way that they develop their advertising campaigns. That's because they have all the data with regard to the customer and who the customer is that they can put in and then analyze to come up with smart advertising approaches. That's using, of course, AI in FSD. We'll be using AI, of course, in the Optimus. How can I forget Optimus's name? And then there's also the AI that's going to be being used in Dojo, and they have become a huge purchaser of Nvidia equipment. Not only for Tesla, but Elon has just purchased, I forget, $250 million, I think, worth of Nvidia equipment for Truth GPT. So, and he's promised that Tesla will benefit from the Truth GPT thing as well. And apparently, Tesla has also got a job application out there for somebody to manage a GPT division of Tesla itself. So who knows where all of this is going to land? Only Elon at this point. But there is no company, yet he's been talking about it, but there is no company that has close to the opportunity to benefit from this tech revolution in AI, in deep learning, language learning, large language learning, and the applications and the actual demonstration of a future product that is going to reduce the cost of doing business or of doing anything. Nobody's even close to Tesla on that. I think Cathie was quite right in her analysis. So I hope this was useful. It turned out to be way more than 15 minutes, which was my promise, but maybe there was just that much useful content in there. And then again, go watch Cathie's entire program if you'd like to see her version of it. And if you liked it. Let me know. I need to know. This is a very expensive product to put on every week. It's one of the more expensive episodes that I produce. So if you don't like it, I don't want to keep doing it. So please hit like. If you're still with me, hit like, subscribe, hit notify. Amazing stuff coming up this weekend, including probably on Monday or Tuesday, I'll do that new video where I talk about the true inflation and how it works and how you can take a look at that on a regular basis to see what's really happening to inflation. And then obviously this is an opportunity for me to talk about possibly getting you to participate with Patreon. I thank all the Patreon people that have been supporting me month after month. I'm so thankful to you, and I could use a few more. So having said all that, it's been great talking to you.